Most people think they understand investing after learning about stocks, ETFs, and returns. But that's just the trailer, not the full movie. What if I told you the real insights, the ones that separate average investors from great ones, are hidden in terms you rarely hear? Words like margin of safety, free cash flow, or Sharpe ratio. Terms used by Buffett, Dalio, Bogle, the people who play the long game. So let's go there. In this video, I'll break down every term you need to truly understand investing, the ones no one explains, but everyone should. Let's go back to a cold winter evening in 1994. Warren Buffett is at a shareholder meeting. A young investor asks, "What's your number one rule for choosing great investments?" Buffett leans in and says just 3 words, margin of safety. The room goes silent. That phrase, to this day, is one of the most misunderstood yet powerful terms in investing. Because behind those 3 words lies a mindset, the mindset of protection, patience, and discipline. But margin of safety is just one of many terms used by professional investors that most people never hear about. Why? Because they're not flashy. They don't make headlines, but they build wealth quietly, like compound interest. This video is about learning to speak that hidden language. Most new investors stop after learning about stocks, risk, and returns. But then, the questions start piling up. How do I compare 2 companies with different growth rates? Why did my portfolio drop when the market went up? What does it really mean when people say a company has a strong moat? These questions don't have simple answers. They require thinking like an investor, not just acting like one. That's what these terms do. They don't just give you definitions. They give you frameworks, using filters to refine investment choices, and mental models. Let's break them down, with examples and stories that'll lock them into your memory. Term 1, capital gains, short-term versus long-term. You buy Apple stock for $100 and sell it for $150. That's a capital gain. But how long you hold it determines how it's taxed. Hold it for under a year? That's a short-term gain, taxed like salary. Over a year, long-term, and taxed at a lower rate. One is punished, the other is rewarded. Long-term investing isn't just smarter, it's often cheaper. Next is tax loss harvesting. Say one of your stocks is down $500. You sell it to lock in that loss, even if you still believe in the company. That loss now offsets gains from other stocks. You pay less tax. It's not about timing the market, it's about navigating the tax code. And pros use it like a secret weapon. Term 3, economic moat. Think of a castle surrounded by a deep, wide moat. That's a company with a durable, competitive edge. Apple has its ecosystem. Coca-Cola has global brand loyalty. That's what keeps competitors out. A moat doesn't just protect, it compounds. The wider the moat, the longer your returns can last. Sharpe ratio. 2 professionals earn 10% on their portfolios. But one rides a roller coaster of volatility. The other barely flinches. Sharpe ratio tells you who earned that return with less risk. High Sharpe, high reward, low stress. Great portfolios grow calmly. Next term is rebalancing. You start with 60% stocks and then 40% bonds. After a market boom, it's 80-20. That means more risk than you signed up for. Rebalancing brings it back to your plan. Sell high and buy low. Emotion says ride the wave. Rebalancing says stick to the map. Term 6, free cash flow. Revenue tells you how much a company brings in. But free cash flow shows what it actually keeps after all expenses. Think of it like your income after rent, groceries, and bills. That leftover money, that's what fuels growth, pays dividends, or clears debt. Free cash flow is the real lifeline of a business. And unlike earnings, it's incredibly difficult to manipulate. PEG ratio. The PE ratio shows how pricey a stock looks based on its earnings, but it completely ignores the company's growth potential. That's where PEG comes in. It adjusts price for growth. A fast-growing stock might appear expensive until you check its PEG. If the PEG is under 1, it could mean the stock is a bargain. It's like getting a head start on tomorrow's winners at today's price. Overbought versus oversold. The market doesn't always run on logic. It runs on emotion. When investors pile in, prices get overbought, inflated beyond reason. When panic sets in, stocks can become oversold, cheaper than they should be. Wise investors look for these extremes as opportunities. It's not about predicting tops or bottoms. It's about recognizing when emotion has gone too far. Term 9, liquidity trap. The central bank lowers interest rates. But even after this, no one borrows and no one spends. That's a liquidity trap, like flooding a dry sponge that won't absorb. Japan fell into one in the 1990s. The US tipped into one after 2008. You can't fix confidence with just money. Term 10, market sentiment. They say buy the rumor and sell the news. Market sentiment is the collective emotion of investors. Fear, greed, hope, panic, they drive decisions more than facts. Sentiment is why bubbles grow. It's also why fortunes are made in recessions. Your job? Observe the crowd and walk the other way. Term 11, black swan events. COVID, 9/11 attacks, 2008 crash. These events were rare, unpredictable, devastating. That's a black swan. It breaks the rules of probability. You can't see them coming, but you can build a portfolio that survives them. That's what diversification is really for. 12, margin of safety. Ben Graham's favorite term. If you think a stock is worth $100, only buy it at 70. That $30 gap is your cushion for being wrong. Investing isn't about certainty. It's about protection when you're uncertain. Margin of safety makes you safer and more patient. Term, dividend yield versus payout ratio. Dividend yield shows what % return you earn from dividends. Payout ratio shows what % of profit the company gives you. High yields, high payout might be unsustainable. Low payout plus steady growth could grow over time. Dividends aren't free money. They come from real profits. So always check where those profits are going. Term 14, trailing versus forward PE. Trailing PE uses past 12 months of earnings. Forward PE uses forecasted earnings. One looks backward, one looks ahead. In bull markets, forward PE dominates the narrative. But never forget, the future is just an estimate. Use both, trust neither blindly. Term 15, covered calls, basics. You own 100 shares of a stock. You sell a covered call, a contract that gives someone the right to buy your shares at a set price. In return, you get paid a premium. If the stock stays below the strike price, you keep the shares and the cash. It's a way to earn income, if you're okay limiting upside. Covered calls are like renting out your stocks. Term 16, inflation hedge. Inflation eats away your money's value. An inflation hedge is anything that protects you. Gold, real estate, tips, even stocks in certain sectors. The key here is the pricing power. Can the asset raise its price with inflation? If yes, that's your hedge. Term 17, bonds. Duration tells you how sensitive a bond is to interest rate changes. Longer duration is more sensitive. When rates go up, bond prices go down, and long-duration bonds drop harder. If bonds confuse you, start by learning duration. It's the volatility meter of fixed income. Term 18, convexity, simplified. Convexity shows how much duration changes as interest rates move. It's like a second-level warning system. Most investors don't know this term, but fund managers live by it, especially in uncertain markets, because sometimes even the safety net moves. Position sizing. Risk isn't just about what you buy, it's how much you buy. Position sizing keeps your winners meaningful and your losers survivable. It's why pros don't YOLO into one stock. They often balance conviction with the caution. Sizing is a strategy and not the guesswork. Term 20, risk-adjusted return. Would you rather earn 15% with high risk or 10% with low? Risk-adjusted return helps you decide. It factors in the volatility, the downside, and the peace of your mind. It's how pensions, endowments, and hedge funds think. And once you start using it, you'll invest like a pro. Now you know the secret language. Not just what investors say, but what they mean. These terms shift your mindset from chasing returns to managing risk, from reacting emotionally to acting strategically. This isn't the end of your investing journey. It's the beginning of a smarter one. With these terms, you'll read financial news differently. You'll understand analyst reports. You'll challenge advice. You'll think twice before buying into hype. And more importantly, you'll build conviction. Because real investors aren't just smart. They're patient, informed, and protected. Now you understand the language investors use behind the scenes. But knowing the terms is just the start. The real challenge? Putting them together to build a portfolio that actually grows. In the next video, I'll show you how to take these concepts and turn them into a real investing strategy. You'll learn how smart investors allocate their money and what they never touch. Don't miss it. It might change the way you invest forever.